So this is FAC4861, FAC4863, Test 4 Success Bootcamp. It's day 2 of 2. And we're going to work through Test 4 of 2020, FAC4861. What you want to get to by next weekend is that when you need to sit back and not just do questions. You need to take a time. I repeat this over and over. I guess like some of my students would know, I probably tell them almost in every lesson, that you need to sit back and not do any questions and just think. So you must try to have a dedicated time where you're going to be. So in your calendar or on your schedule, you must put in your calendar or on your schedule thinking time. So this thinking is a little bit more specific. So in general, you must have thinking time, like just how your day went. But for this, you must be a little bit more specific in the sense that you're going to set aside whether it's 20 minutes, whether it is 30 minutes, where you must sit back and think. Think about what? It depends on, so you can't do all of them in one 30-minute session. But let's say, for example, you take FAC1. So you have a 30-minute session for FAC1. Then you need to tell yourself in FAC1 or FAC3, the topics that you need to know. So the topics, so remember, it does not mean you must not know the other topics, but the topics of test 4, those will be the main topics. So you will tell yourself the main topics for test 4, for FAC1, FAC3 is employee benefits, it is leases, it is provisions, and it is the other one, events after the reporting date. You want to be able to tell yourself in employee benefits, what are the key issues? Then you want to identify the key issues, and you want to be able to perhaps answer them in your head, or if you want to write them down. Okay, so just the key issues. Then you move on to leases, for example. Then you sit with the leases and you say, okay, in leases, what are the key issues? So remember, for leases, there's a few things that can be tested. It is, so the key issue of leases, what is the key issue? So when you want to identify the key issues, the key issue is basically the objective of the standard. So when it comes to leases, the objective of leases is to provide the presentation, recognition, and measurement of lease contracts. Okay, but obviously that is the key issue or issues. But now I need to go a little bit more in detail. What is the detail? That they can ask you about identifying whether a contract is a lease or not. They can ask you for lessees, and then under lessees, what are the various issues? They can ask you for lessors, and under lessors, what are the various issues? So that is basically what you want to sit. So for 30 minutes, you must sit back and think about it and talk to yourself, okay? So this is gonna be a mechanism for one of two things. It's gonna help you, one of two or even both. It's gonna help you to identify what you do know. It's also going to help you identify what you do not know. And then all you have to do is to go read up the section of what you do not know. So I always tell my students, and I'm talking about previous students, when they study for the exam, right? It's virtually impossible to run through every possible question. So what you do, you set yourself a schedule up, and you write down all the topics, and then you see which topics you haven't covered and which topics you have covered. After you have done that, you sit and you think through the various issues. And if you can't think of, let's say you don't know how to do finance leases for lessors, then all you go do, you don't go do the entire lease topic. All you focus on is finance leases for lessors. That is how you will learn. And that does not mean you don't know finance leases for lessors, that you don't know leases. You only don't know finance leases for lessors. So take note, that is how you will take stock. That is how you will reflect on what you do know and what you do not know. And while you study, when you prepare for the exam, so that's the first issue. The second issue, when you prepare for the exam, make sure once you're done with question 1, let's say you're dealing with employee benefits and you're doing your first question on employee benefits, make sure you look at you mark yourself. You try to identify what you do, what you got right, and you try to identify what you did not get right. For the things that you did get right, just make sure, just run yourself through, run it through your mind to see whether you actually do really know it, or if you got it right by chance. Okay, you just want to make sure that you didn't get it right by chance. You want to ensure that you got it right because you actually do know it. So generally, you're going to get it right because you actually do know it. So that part will be quick. Now, for the part that you never got right, the part that went that you never got right, you need to identify where did you go wrong and why did you go wrong. Okay, and then you try to find out what is, and you try to identify what is the correct way of doing it. So that is important. So when you go into the second question for employee benefits, you now, before you start your second question for employee benefits, you do 3 things. Number 1, you remind yourself of the key issues of employee benefits. Okay, so you just quickly, it must take like 5 minutes. So just before you start your question, 5 minutes, take about 5 minutes or even 15 minutes, doesn't matter, but you must dedicate an amount of time where before you start your question, you remind yourself of the key issues of employee benefits. That's the first. The second, you want to remind yourself of the things that you got wrong so that it's fresh in your brain, because the whole idea is you don't want to repeat the mistakes, you want to correct the mistakes. So by reminding yourself of the things you got wrong and that you rectified, you want to tell yourself you don't want to repeat those mistakes again. And then the third thing you want to do is, even though you're not working under time pressure, just tell yourself, I want to finish this question as fast as possible. So that's what you do with question 2. Once you're done with question 2, you go again through a review process. It doesn't have to happen immediately. You can take a break, but basically before you start question 3, you must first review question 2. Now, question 2 is a little bit longer in terms of review. When you review question 2, you're doing the same like you did in question 1, which is, what did I get right? And if I got it right, if I actually got it right, or if I got it right by chance. The second, what did I get wrong? Why did I get it wrong? And how do I fix it? Okay. And while you do that, you also want to have a look, how did they set out their solution and all of those type of things? Is your way better than their way, or is their way better than your way, and so forth? So while you are looking at what you got right, what you got wrong, you also look at how they set out the solution. Okay, so that's important. So now you have identified what you got right, and you confirmed that you got it right because you actually knew it. Then you also identified what you did not get right, and you have now corrected. Before you go on to your third question, let's say you're doing 3 questions. Before you go on to your third question, you want to do a comparison between question 1 and question 2, because you did 2 employee benefit questions. You want to ask yourself, what are the similarities in question 1 and question 2, and what are the differences? You want to have a look at what are the principles being tested. Was the required similar, or was the required different? If you go through a few employee benefits, you will tend to see the required is quite similar. It will tell you, please disclose the profit before tax note. That's what they tell you. And then you must do employee benefit calculations. That will include sometimes leases and all of those, but in most, the majority of the marks is because of employee benefits. So so the similarity is generally they ask you for the profit before tax note. Then you want to have a look. So now you compare similarities, right? What did they do the same? So you look at on 3 levels. Level number 1, required. Level number 2, how did they present the scenario? And then level number 3 is the principle being tested. Look for similarities, and then you also look for differences. So that is what you call learning. When we're running through tens of questions, that is not learning. That is just running through questions. If you're running through questions and you're also applying this level of thinking, then that's okay. But the chances are most of you are working full time. The chances are of you running through 5 question papers for each subject, it's not going to happen. So unless you're really, really quick, right? But it's hardly going to happen unless you're for a month at home, then it can happen. But if you're not for a month at home full time, the chance of you running through 5 question papers for each subject is virtually impossible. So what do you do to actually ensure that you give you the best possible chance? You just learn properly. That's all you have to do, is learn properly. So there's a big difference between just studying and learning. Well, it's probably the same thing if you look at the definition, but like for me, learning is where you actually, when you leave the session, you can actually feel that you have achieved something. In most cases, what we do, we go into a panic mode. I was one of those then. We go into panic mode. So we just want to run through question papers thinking. The only thing we get is like eating a chocolate, and that is comfort, right? But what is it actually? There's no real, well, maybe some chocolates are good, but just running through 5 question papers and not being able to actually sit back and tell yourself what you actually learned, then you must know you didn't actually learn. You just went through 5 question papers. If you can sit back and identify the similarities and differences between 2 questions, then you know you have learned. And when I say you identified similarities and differences, I don't want you to repeat the solution. If you are just repeating the solution, that is not necessarily an indication that you have learned. You must be able to identify the actual principle being tested. You may refer to the solution, but you don't just want to say in the solution, they say 10 times 2. Or what does that even mean, 10 times 2? You understand? You want to be able to say what was the principle tested in this one versus the principle tested in that one. If you're going to do that, I can promise you, if you do 2 to 3 questions, it's over enough. You can't do 1. If you do 2 to 3 questions, you will get 60%. That I can tell you. You're not going to get 40. You're not going to get maybe 50, depending on the level of difficulty, but it's going to be more than 50%. If you like for me, I never breached the 60% mark. Why? Because I used to do 1.5 question papers before. But what I did was, I did it like I'm telling you now. It's not my method. It's not my method. I've just watched, observed how, like my friends, my peers, and the other guys in the guys that did well, how they actually studied, and you and if I observe how they studied, they were very diligent people, right? And you see how they studied, and you actually see what actually caused the learning. It is not just about running. So I know, like I told you, running through a lot of papers is not necessarily the right approach. So when I was in 3rd year, the guys in CTA, the one guy that came first in CTA, he said he never, so at UCT, they give you a pack, right? So with each, let's say each topic, they give you a pack that will probably have between, depending on the topic, but mostly about 4 to 5, they call it tutorials. You must do it on your own. So out of the 4 or 5 tutorials, 1 they do in the tutorial session, the rest you do on your own. And you must learn from the solution, right? Well, you can obviously ask people, but basically you learn on your own. So he said he never, and I'm talking about, and he was a guy that wanted to be the best. He works under, from question 1, he works under time pressure. And he said he never finished in every week, he never finished every question. And in fact, for his entire year, he never finished every question. He never got to every question. He only basically, his strategy was, because it was too much work, too little time, and he came first, he focused on doing 2 to 3 questions, but he did it properly. And that's how he did it, right? Obviously on a next level, right? But then there was another girl that came 3rd or 5th. She managed to work through everything, but she also worked on that level. So she was probably just much quicker. Or maybe she wasn't as deep as him, or maybe maybe she wasn't as deep as him, because he used to go read like IFRS, like to another level, right? But basically, but she also, the common thing was, she also did this thorough way of studying. So that is the important aspect. So whether you get through 5, 3, or you get through everything, if you are doing this level of training, of learning, then you can feel, you know you're on the right track. So it might sound hard. So what some people tell me, I'm not going to get through a lot, so that means I'm only going to work through 2 papers where I can be working through 5. And the answer is yes, you're only going to be working through 2 where someone else may be working through 5. But you that working through 2 is actually in a far better position than someone working through 5. Like I told you, you will get now after test 4, if you didn't get it already, for FAC4862, you're going to get, or FAC4864, you're going to get TUT letter 106. And TUT letter 106 is a TUT letter of past papers, 10 case studies of 2 questions each. Each case study have 2 questions. So that means you have 20 questions. Each question is 100 marks. So that is 2,000 marks. One guy that came to me in test 4, he only came for me for test 4, but then he was happy with test 4, then he came back for the exam prep. And he asked me for advice, and I told him, don't go through everything, just make a selection. He felt, because he was a full-time student, whatever, he felt he could work through all 20 questions, and he did work through all 20 questions. But the result was still 20%. Why? Because working through all 20 questions is impossible. If you're just running through questions, you can just answer that particular question, and you haven't taken a minute to ask yourself, what did I learn? That is the critical question you need to ask yourself after each question. What did I learn? If you can tell yourself what you learned, then you're on the right track. If you can't tell yourself what you learned, then you probably have to redo the question before you move on to a next question. That is of utmost importance. So just take note of that. And remember, you also want to ask yourself what ifs, right? What if this, what if that? So even though you are working through 2 questions, so someone can be working through 5 questions, they're just running through 5 questions. So that means they can only answer those 5 questions, and they'll only succeed if those questions or those type of questions come in. Someone doing 2 questions and basically doing a thorough review. A thorough review also includes asking what if. Like the typical example, I would explain what I mean by this is that when you did WAC, right? So in MAC, when you do WAC, then you must calculate the cost of equity for ordinary share capital. So there are 3 methods to calculate the ordinary share capital for the cost of equity. There's 3 methods to calculate the cost of equity for ordinary share capital. So perhaps in the question you worked through, they asked you, you needed to calculate cost of equity for ordinary share capital using the dividend growth model. So when you go through, you do the review, and then one of the parts of the review is to ask yourself, what if? So the what if is, in this question, they asked you for dividend, they asked you to calculate cost of equity, and you did it using the dividend growth model. So you must ask, what if it was the other 2 methods? What if it was CAPM? What if it was the bond yield plus risk premium method? So now you're asking that question, and then you must tell yourself, if it was CAPM, what would I have needed? I would have needed A, B, C, and D. So while I'm only doing that 1 question, I'm effectively covering the entire syllabus. So I go into question 2, I do the exact same thing. So by the time I'm done with question 2, I've covered the entire syllabus, not the entire syllabus, the entire topic, the major issues of the whole of WAC, while someone went through 5 questions, but they perhaps didn't cover everything, because maybe all 5 questions didn't have WAC, And all 5 questions perhaps didn't ask a cost of equity in the different methods. So those are the type of things you want to do. Don't think running through a million questions is going to help you, but rather do it properly. Now, once again, I'm not saying do 1 question. You want to at least do 3, okay? Because that will give you a good opportunity to work through different scenarios. But you must also be exposed to different scenarios. Otherwise, you can't do any comparison. Okay, so just be aware of that. You have like a week, 10 days after this to implement that. So try to implement that. Okay. So let's move on to this particular question. We're going to go into test 4 of FAC4861 of 2020. It's a short scenario. We're going to read through the scenario. As we read through the scenario, I will point out some important aspects. I'm telling you that the scenario is dealing with 2 parts, 2 topics, leases and provisions. Okay. It does not have events after reporting it. It does not have employee benefits. If you have a look at the past, I couldn't find too many past test 4 papers, but basically leases is an account for majority. So make sure you know leases quite well. Okay. So you should be able to see the scenario. So this here is test 4 of 2020, FAC4861. So they say ignore value added tax. So they say Catwalk Fashions is listed on the Johannesburg Stock Exchange and has a 30 June financial year end. The company manufactures and sells highly fashionable clothes to major clothing retailers in South Africa. Okay, so in the first 2 paragraphs, the important aspect is your financial year end, 30th June. And then the second paragraph, you can understand that the company manufactures and sells highly fashionable clothes to major clothing retailers in South Africa. Remember, it's important to identify what the company is doing. So what you must know that anything that they manufacture and sell, so what they manufacture would be inventory, and what they sell would be the revenue. Okay, so basically so the high fashionable clothes, that is the main business operations. So here they say lease with Easy Rent Ltd. Catwalk Fashions has factories in 4 South African provinces and decided to open up its 5th factory in the Eastern Cape. However, due to financial constraints, Catwalk Fashions could not afford to purchase a factory building and therefore decided to lease a factory building from Easy Rent. The lease agreement contained the following. So we have the commencement date of the lease, 1 July 2018. Remember, what is the commencement date? That is the date when we do initial recognition, okay? Then they say lease installments, monthly lease installments payable at the beginning of each month, and that is 437,000 per month. What's important over here is a monthly installment and it's at the beginning of each month. Remember, when we're going to do the present value calculation, we need to make sure whether whether payments happen at the beginning or at the end. So here they're telling us at the beginning of each month. Then they're telling you an annual installment. The annual installment is 2% of annual revenue relating to the Eastern Cape factory. So remember, in the lease agreement, when we calculate the lease liability, one of the 5 components is a variable lease payment. But remember, that variable lease payment is a variable lease payment that is linked to an index like the inflation rate, CPI. This here is linked to revenue. So this is not that variable lease payment that will be included in the lease liability calculation. Okay, so they say Catwalk Fashion's audited revenue relating to the Eastern Cape factory amounted to 4.5 million for the financial year ended 30th June 2020. So that means in the financial year 30th June, the variable lease payment would be 2% of 4.5 million. So we will say debit variable lease payment, P&L, credit bank, assuming we paid it, 4.5 million times 2%. The lease agreement provides for a residual value guarantee of 30 million rand for the factory building. However, at inception of the lease, Catwalk Fashions estimated that the factory building would be sold for 28 million at the end of the lease term due to expected excessive usage of the factory building. So what are they doing? So remember, a guaranteed residual value you must include in the lease liability calculation. Remember, that's one of the 5 components. In no particular order, but component number 1, you include fixed lease payments. Number 2, variable lease payments linked to an index. Number 3, a guaranteed residual value by the lessee. So because the lessee is guaranteeing this residual value, you must include it. However, because the lessee is going to sell it and they're going to get 28 million, we will reduce the guaranteed residual value by the 28 million. So in effect, they're going to be paying 30 million to the lessor, but they're also going to get 28 million because of the sale. So that means the net impact of the cash flow is going to be an outflow of 2 million rand. Then they say the rate implicit in the lease is not readily available, is not readily determinable at the inception of the lease. Catwalk Fashion's incremental borrowing rate was determined as 6.8% for a similar lease with a period of 9 years and 7.5% for a similar lease with a lease term of 12 years. You may assume that these rates remained unchanged. Okay, I probably forgot this. Lease term over here is 9 years. There's an option to renew the lease term at the end of the lease for an additional 3 years. Okay, that's why they're giving you a rate for 9 years and a rate for 12 years. Remember, what's the rule or the principle is that at inception, if we expect to renew the lease, then the lease term is 12 years. If at inception we do not expect to renew the lease, then it will just be the 9 years. So here they say Catwalk Fashions indicated that the company intends to exercise the renewal of the lease at the end of the lease term. So what does that mean? That we will have to, the lease term is 12 years and not 9 years. So the discount rate that we will use is the 7.5%. The useful life of the factory is expected to be 23 years. Okay, so the useful life is expected to be 23 years. The lease agreement specifies that the lease payments will increase every year on the basis of the increase in the consumer price index for the preceding 12 months. At the beginning of the 2020 financial year, the lease payment has increased with CPI. The CPI rate at the beginning of the 2020 financial year is 4.5%. Okay, so at initial recognition, there's no impact, but in the 2020 financial year, there's going to be an impact because the variable payment is increasing as a result of an index, which is CPI. So Catwalk Fashions measures its right of use asset according to the cost model in terms of IAS 16 property, plant and equipment, and accounts for depreciation on the straight line method. Right of use assets are presented in a separate line in the statement of financial position. So what do they mean over here? Is that the standard allows you to include a right of use asset with any other similar asset. So for example, the right of use asset we are leasing. The right of use asset that we are leasing is a building, and we are using this factory building. So therefore, because it's used in the production of income, it is in effect classified as PPE. So the standard allows a company to decide whether they're going to whether they want to include lease properties with PPE or whether they want to show it separately. So on the statement of financial position, you can just have property, plant, and equipment, and included in property, plant, and equipment is the right of use asset. Or on the balance sheet, you can show the right of use asset separately. So in this case, they have chosen to show the right of use asset separately and to not include it in the PPE balance. Okay, so just take note of that. And I'm assuming most retailers will include the right of use asset separately because it's a significant balance. You may assume that the South African Revenue Services grants a 5% deduction per annum on factory buildings. The financial accountant, Mr. Uncertain, did the following calculation for the lease transaction for the year ended 30th June 2019. So remember, at inception is 1 July 2018. So this is basically what he did on for the 30th June 20 at inception, okay, at initial recognition. So basically, he should have recognized the journal on 1 July 2018. And then at 30th June 2019, he should have done the subsequent measurement transactions, which is a variable lease payment, which is the depreciation for the right of use asset, and it is for the payment, okay, the lease payment. So we just have to have a look what he actually did. So here's the calculation. We'll go through the calculation now. But basically, Mr. Uncertain only processed this journal entry below regarding the lease transaction for the year ended 30th June. Okay, so he said debit right of use asset, credit lease liability. So he correctly recognized the asset. We'll have to check whether the amount is correct. But what did he not do? He did not recognize he should have recognized the subsequent measurement journals as well, which is, so he should have recognized the subsequent measurement journals as well, which is the depreciation, which is the payment for the lease liability, as well as the variable lease payment. Okay, they never gave us an amount for the variable lease payment because they only gave us a revenue for 2020. They never gave us a revenue for 2019. Unless I missed it. I don't know. Yeah, but anyway, what did they say? Yeah, 2% of annual revenue. So they never gave us revenue for, unless this is 2019's revenue. I don't know, we'll see now. Okay, so let's have a look at the calculation. So he used 6.8%. But what should he have used? He should have used 7.75. His payment is 437, which is correct. The future value is not correct. The future value should have been reduced by the 28 million. So he correctly included 30 million, but he incorrectly excluded the 28 million. So the future value should have been 2 million, which is 30 million minus 28. N should not be 9, N should be 12, because we expect to renew, we have the intention to renew the contract. And then very important, he did not, this needs to be changed to, beginning. Okay, so then there's no indication that he's using the beginning of the year. So he should be using payments at the beginning. Also, remember what's important. This amount is a monthly amount, where this rate refers to an annual rate. We just see quickly. Yeah, so the rate is an annual rate. So what do we need to do over here? This rate needs to be converted into a monthly rate, because this is a monthly payment. And this N needs to represent the number of months, not the number of years. So that's also a problem. So there's two problems. Firstly, use 9 and not 12. And secondly, it did not multiply by the number of years, because this payment is a monthly payment. So we need to obviously fix that. Okay, so just be aware of that. I'm not going to read the next part. We will read the next part afterwards. Okay, so let's quickly go into the lease, the required. So required says, prepare the correcting journal entries to correctly account for the lease transaction in the financial records of CAT Fashions for the financial year ended 30th June 2019. Journal narrations are not required. Provide one cumulative journal for the monthly recurring journals. Okay, so remember what they mean over here. Because the payment happens every month, they're not saying you must do 12 journal entries. They say just lump all the payments into one journal entry. So you must, so just take note of that. Okay, because someone may spend the whole afternoon, the whole hour writing the 12 journal entries for the payment, where you just need to make one journal entry for the payments. Okay. So there we have, that is 18 marks. Then here, we're going to do the note disclosure, which is 7. And there's one communication. So 1 plus 7 is 8. 8 plus 18 is 26 marks for lease. Okay. So I just switch over into Google. I'm going to switch over into Google, and then we are good to go. Okay.
Fires?
Yes.
So, because we said that we're going to be accounting for the extended lease term, if at inception there is that high probability that we're going to be extending. So if we change our mind in between, what happens?
Be a reassessment.
Then it's a reassessment. Okay.
Okay, so you see Google Sheets? Can you see Google Sheets?
Yes,
okay,
we can.
Cool. So let's work through what should have actually taken place. Okay, so remember, they want us to do the correcting journal entries. Let me just see where. So they want us to do prepare the correcting journal entries to correctly account for the lease transaction in the financial records of Cathawk Fashions Ltd for the financial year ended 30th June 2019. Okay, so I'm going to assume that revenue amount that they gave us not for 2020, but rather for the 2019 financial year. Otherwise, we can't calculate the variable lease payment. Okay, so just take note of that. So let's do this journal entry. So on 1 July 2019, on 1 July 2018, he did the correct journal entry of saying debit right of use asset, credit lease liability, but his amount was completely wrong. Okay, so his amount was completely wrong. So let's have a look how we would go about doing this. So, what is this now? Just see quickly. Part A. Okay, so for part A, here we're going to go part A. So remember, so we must do a correcting journal entry. Okay, so yeah, so we have to do a correcting journal entry. So let's have a look how we will go about doing this. So on 30th June 2019, okay, we're going to do the correcting journal entry. So I have my debit and I have my credit. So remember, what's going to happen in our journal entry, we're going to have a debit, right of use asset, right of use asset. So I know that, and I'm going to have credit, lease liability. Okay, that is what would have happened at initial recognition. We know his initial recognition is wrong. So we're gonna have to correct initial recognition. Okay, so that's why I know I'm gonna have an adjustment being made to right of use asset. Then I'm gonna have my subsequent measurement. My subsequent measurement is the depreciation, is the lease payment, and then the variable lease payment. So subsequent measurement is, so remember subsequent measurement, we're going to have subsequent measurement on the right of use asset as well as subsequent measurement on the lease liability. So subsequent measurement on the right of use asset would be depreciation. Don't forget this, okay? You're going to lose marks if they're not going to mark your journal entry if you don't put that in. So don't lose marks because you're not putting that in. So depreciation, P&L, and then accumulated depreciation, right of use asset. You obviously have to write in full. I don't have to because I'm not writing an exam. Okay, so SFP. The next journal entry would be relating to the lease liability. Okay, so for the lease liability, we are making a payment. So we're going to say bank, we're going to credit bank, SFP. There's going to be finance costs, so interest expense or finance costs, whatever you want to call it. That's going to be P&L. And then the balancing figure will go against the lease liability. And that is SFP. Then we will have a variable lease payment. So we're going to say debit, variable lease payment, P&L. And what is this? We can call it bank. They never said whether we paid it in cash, but just assume it's in cash, doesn't matter. Okay, so there we go. So credit, bank, SFP. So remember, we are dealing with the 30th of June 2019 financial year. So 1 July 2018 to 30th June 2019. One of the important aspects to do in financial accounting or financial reporting, whether you groups or non-groups, is when they give you the date, just write the date on your page, opening, beginning, and end, so you don't have to think. Remember, you want to reduce the amount of unnecessary thinking. So anything that you can put on the side of paper to reduce the cognitive load from your brain, try to write down things that you don't need to remember. Okay, so please do that, so you can rather let your brain do the heavy thinking for what he needs to think or what she needs to think, as opposed to remembering things that you can just write down. Okay, so now we're going to do a calculation. Just one thing to take note: these easy marks that many lose. Okay, and that is if they don't tell you to ignore deferred tax, then that means you must show a deferred tax calculation. Okay, so I'm not going to put in the journal entry. I don't know which direction it's going in, but we must bring in deferred tax as well. Okay, so remember, we're going to have deferred tax and income tax. So what I'm going to do, I'm just going to put here deferred tax along, and I'm just going to say SFP, and then I will see, so I don't forget about it. Okay, so then we're going to put in the other side of the entry. The other side of the entry is going to be income tax. I'm not putting it in yet, but I don't know whether it's debit or credit. Okay, so we will see now. So they never said do not do deferred tax. So because they did not say that, it means we must do deferred tax. please take note. Similarly, if they don't tell you ignore narrations, then you must do narrations. Now, if they don't say ignore comparatives, then you must do comparatives. So if they don't say ignore deferred tax, then make sure you bring in deferred tax if you have journal entries. Okay, so now we can do our working. Okay, so working one, we need to work out what is the right of use asset and then what is the lease liability. Now, in this case, the right of use asset is quite straightforward, right? But I want to still go through the process of what goes through your mind. What I'm going to write down here, you don't have to do, but what I'm writing down here or typing out here, you must process through your mind when you think of a right of use asset and when you think of a lease liability. So train your brain how to think when it comes to right of use asset, when it comes to lease liability. So the way what I'm writing down here, you don't have to do in your workings in an exam because it's not applicable. But what I'm writing down here is what is basically going through my mind. So that's what you want to do, is train your mind how to think about something so that you kind of have a set way of thinking. So you will be able to pick out what is relevant and what is not relevant. So for example, you must do this for all subjects. So for me, when we want to work out, when we want to do this journal entry above, right of use asset, lease liability, I know that means I need to calculate the right of use asset, and that means I need to calculate the lease liability. So for me to determine what is the right of use asset, I tell myself the right of use asset includes 4 components. What are the 4 components? It is the lease liability. It is initial direct costs. It is, what else is it? Lease liability, initial direct costs. It is prepayments. And it is a provision for dismantling. Okay, we just call it like that, whatever it is. You know, that provision of restoration, provision of dismantling, provision for decommissioning we did yesterday. So it can come in here as well. Okay, so that is what makes up the lease liability. Makes up the right of use asset. So like I said, there's no need to write this down because you're going to be wasting time in an exam. I'm writing it down just to show you what I'm thinking. So when you look at the right of use asset, what must go through your mind? If the right of use asset includes these 4 components, then you identify which of these 4 components is relevant to the scenario. And then based on the scenario, the only relevant one is lease liability. So this is 0, 0, and 0. Okay, so that is what you want to do when you think. So remember, like I said, when an examiner sets a question paper, they don't set time for thinking, because the thinking had to have happened before. So this is how you don't think in an exam, because your brain is trained to think in a certain way. So when your brain sees right of use asset, automatically what goes through the mind is a right of use asset includes those 4. Automatically, because your brain knows those 4 components, when you are reading, it's going to pick up that there's only a lease liability and you don't have anything else. But if you have not trained your brain to think in that way, it's not going to pick up. Then it expects you to use your conscious mind to actually do all the necessary thinking. And that is why you're also losing out on time in the exam. So you need to make sure that you put some stuff on automation. Okay, so remember, we live we live in the smart economy. Cars drive on its own. So many things happens on its own with AI and all of those type of things. So artificial intelligence has come because of how the human mind works. So our brains can be on autopilot. So just make sure you train your brain to be on autopilot so you can pick up this kind of stuff. So just make sure that you do train your brain to think in a certain way so that when it sees certain things, it's going to automatically pick up what is relevant and what is not. So here, that's going to be the right of use asset. Like I said, there was no need to write this down because as you're reading the scenario, because you trained your brain to think of all four, your brain is going to pick up that there's no provision, there's no prepayment, there's no initial direct cost. So your brain will know that the only thing including the right of use asset is the lease liability. So you only write down the lease liability. So that means we need to work out the lease liability. So for the lease liability, I do the same thing. I train my brain to know that when I calculate the lease liability have 5 components. What are the 5 components? Fixed lease payment, variable lease payment, but linked to an index. What's others now? Guaranteed residual value, purchase option, and termination penalty. Remember, just take note, a contract can have a purchase option. It does not mean you must include it. You only include a purchase option if you expect to exercise that option. Similarly, a contract can include a penalty, but an early termination penalty, but you only include it if you expect to early terminate. Okay, so just be aware of that. So now, when I read the scenario, my brain already picked up that there's a fixed lease payment, there's a variable lease payment, there is a possibility of a variable lease payment linked to an index, there's a guaranteed residual value, there's no purchase option, there's no penalty. With a variable lease payment linked to an index, there was that aspect. But remember, the index only impacted the 2020 financial year. We are busy with the 2019 financial year. So at initial recognition, there's no impact on the variable lease payment. Over here, the fixed lease payment was a monthly amount of 437. I cannot remember. 607.29. Okay. The guaranteed residual value was 30 million. 123 minus 28 million. 123. Okay. Purchase option 0 and 0. Those are the amounts, okay? But now we still need to do a present value calculation. So what are we going to do? We need to do a present value calculation. We want the present value. So we need the future value, we need PMT, we need N, and we need I. Okay, so.
Sorry for ease.
Yes.
Hello, you're talking to Kaylin,
Yeah.
Olan. So can you please just talk through the residual value, the 30 and the 28, and just why we are subtracting those amounts, please?
Okay, so what's happening over here with the guaranteed residual value? We guaranteeing the lessor that we're gonna, at the end of the lease term, we're gonna pay them 30 million. Okay, but what's happening actually is that what we are guaranteeing the lessor is that at the end of the lease term, they're gonna get 30 million rand. So whether we're gonna take the lease building over or not, they didn't say that. So what we are telling the lessor that at the end of the lease term, they will be able to get 30 million rand. What they're actually going to get at the end of the lease term, based on our estimate, is that when they sell that building, they will actually only get 28 million. What did we guarantee the lessor? 30 million. So because the lessor is only getting 28 million, for him to get 30 million, we need to come up with the extra 2 million. That is basically what we are telling him. That's basically what we are doing. We're just ensuring that the lessor is guaranteed 30 million rand. The lessor is going to get 28 million rand at the end of the lease term as a result of selling the factory. But that is not 30 million. So how do we get to 30 million? We have to give them, we need to give the extra 2 million. So that is basically what we're doing over there. Obviously, these are all estimates. Things can change. Then as things go along, we'll have to maybe do reassessments. But at this point in time, that is the outflow that we're going to have at the end of the lease term. Does that make sense?
It does. Thank you.
So
Yes.
the present, yeah.
How would it be different if they had not told us anything about the selling price at the end of the period?
Let me just give it 30 million. Let me just
So we'll just include 30 million on the guaranteed residual value.
yeah. If they didn't speak about that 28 million, they said that 28 million was not in the scenario and they only mentioned the 30 million, then you include the 30 million. But in most cases, they'll probably made that number 2 million. With 30 million is too excessive for this, what you call it, you understand, for this type of how can I say, scenario, yeah.
So if it was
Okay.
32 phase, if it was 32, which was the future value, the future residual guaranteed value, and what we had contractually as the guaranteed residual value was 30. So meaning they are going to get more. I don't know if it's possible, that thing.
Yeah,
if they are going to get more than what we have contracted, then we're going to change that to a 0 because we don't have any outflow.
Correct.
Okay.
Yeah. It's similar to, I don't know if you, like, I'm not too familiar with it, but I do know about it. Like in the car business, right? When you take out so for example, if you buy a car and let's say you take out finance, BMW, for example, and then after 5 years, you going to trade in your car for a newer car. You have an option whether you want a guaranteed residual value or you don't want a guaranteed residual value, right? So with a guaranteed residual value, it means that at the end of, on the day when you take out the car, that in 5 years' time, they're going to pay you whatever amount, 100,000 Rand. So what most people do, they don't take it out. Some people do just to be safe because they risk averse. Some people don't take it out because if you don't take it out, you're going to get the value of whatever it is at that point in time. So in the car business, they do kind of have this kind of arrangement when you buy, when you take out a vehicle and you're going to trade in regularly. So then they give you an option of either having a guaranteed residual value at the end of your term, or you don't have a guaranteed. So I guess it is common practice. How it exactly works, I can't give you the details, but I have, like, if you just read some of how car terms work, then you will see that this option is available. So they will obviously have whatever they are, they will deal with it when they have these arrangements with customers. Okay, so now we have all those numbers, but now we need the present value. Remember, we want to work out the present value. So what is the future value? Remember, you must understand the definition of the future value. The future value is the lump sum payment at the end of the lease term. So a lump sum payment is a once-off payment. Okay, so the future value is a lump sum payment at the end of the lease term. So of all these numbers over here, we only have 2 numbers. So the lump sum payment is going to be the guaranteed residual value. Your payment, what is the definition of a payment? A payment is a fixed regular payment. A fixed regular payment. So the fixed regular payment is going to be the fixed lease payment. So now we must have a look what we're doing over here. N is the number of compounding periods. N is the number of compounding periods, or another way to look at it, N is the number of payment periods. The way you get that, okay, so this here is lump sum at end of term. This is a fixed regular payment. The word fixed mean it doesn't change. A regular mean at a it's at the same time every year, every time. So every month you're making a payment. It's not in 1 year, then in 6 months' time, and in 3 months' time. It is every time. It is every single month, or it is every single year, or it is every quarter. So it must be regular, and then it must be fixed. If it changes, then it can't be put up payment. N is the number of compounding periods or the number of payment periods. So the number of compounding periods is basically, so this here is number of compounding, or you can think of it as payment periods, compounding periods. And that is equal to the following. Number of years multiplied by number of compounding periods per year. Okay, so remember the number of years is 12. The number of compounding periods per year is also 12, because you're having monthly payments. So the number of payments or the number of compounding periods per year is 12, and the number of years is 9 plus 3, which is also 12. So therefore, this is 12 times 12. Then I, because they gave us two i's, I is going to be your so that when you look for I in leases, for lessees, it's going to be the rate implicit in the lease. So you always use the rate implicit in the lease unless what? Unless it that rate is not determinable. And if that rate is not determinable, then we use the incremental borrowing rate. They gave us two incremental borrowing rates, a 6.8 and a 7.7. So we're going to use a 7.75 because that represents the period we are working with, a 12-year period. So we're going to, this is going to be 7.75%. But remember, we need to divide it by the number of compounding periods. So we divide it by 12.
I think you are supposed to say 0.075.
So there we go. If I do that, if I change, can I just do that? Okay. So there we go. 12. 7.75 divided by 12. Yeah, okay, cool. Wait. 7.75 divided by 12. I think that should be fine. Okay, so 7.75%. Yes. Okay,
Maybe
so there we
before we
go.
move, Faiz, maybe before we move any further,
Yes.
let's do the practicals of that what if analysis as we are doing this. So if we had a purchase option, right, that purchase option, would it increase the lump sum at the end.
Yeah, because a guaranteed residual value, this would happen at end. This would happen at end, and a termination would also happen at end. Because remember, with a termination, because you're ending it, you're going to have to make a payment. So because the thing comes to an end, you would make that payment. So it would also happen at the end. So basically that, remember, but you can't have a purchase option and a termination penalty, because
Sure.
the lessor is not going to sell it to you if you early terminate. You understand? So it'd be one of the two. Well, I mean, it can be both if you are, you're good friends. But other than that, that is basically how it will work. So that would all be future value.
Okay.
Okay, so just important points over here. I must be so I'm assuming your financial calculator is 1 per year. Okay, so I'm assuming your financial calculator is in the format when you have HP and you say second function clear all, it will read 1 per year. Okay, so this over here is a monthly interest amount. N represents the number of monthly payments, and PMT is the payment per month. So as you can see, all of them is in the same denomination. I is the interest rate per month. N is the number of monthly payments, and PMT is the payment per month. So, and then on your financial calculator, your when you have HP calculator and you say second function clear all, it must read 1 per year. Okay, what you must also just make note for them. So what I'm going to do over here, just for this purposes, so this is going to be end or beginning, right? So remember, for Excel, beginning is 1. Okay, for Excel and for Google Sheets, beginning is 1. If it's at the end, it is 0. So you must just indicate this if you do in your exam, because they need to know that you must put your calculator at the beginning or at end. If it is if cash flows happen at the end, there's no need to show this, okay, because it's just generally accepted that it'll be at the end. But when they specifically say beginning, show them that you must make it at the beginning. If you are using a financial calculator, then you must convert your calculator to beginning mode. So we're going to say equal, I'm calculating the present value. So the present value is I in PMT future value, and now they ask for beginning or end, so I will put in 1. So Excel knows that. So there we go. Okay, so 42 million. Now remember, the guy already, Mr. Uncertain, already recognized something. Okay, so we might just take in the difference. So we just need to take in the difference. So the lease liability is 42 million. So that is the lease liability. Over here, the right of use asset is going to be 42 million. Okay, and this is going to be working 2. Now, this guy already recorded something, so we need to do the difference. So working 3 should have current. Okay, so this will be the correction. So this will be the correction. So should have been 42 million. Okay, so should have been 42 million. Right of use asset and also the liability, lease liability. What he actually did was, what did he do? Can't remember. What did this guy recognize now? 19,000. $19,470,634. $19,470,634. So he did 19,470,634. That's what he recognized. So the adjustment is going to be as follows. So the correction must be that minus that. Okay. So the adjustment, right of use asset needs to increase because it should be 42. He had 19. So right of use asset is increasing. Right of use asset is an asset. So an asset is increasing, an asset increases on the debit side.
Just to share, Faiz, for those who are using Excel like me, rather than working going downwards, I prefer to work going sideways. In that way, I'm sort of using a double page. On here, it's what I'm submitting. On the other side, then it's my workings. When I'm done, I just create a page break to break the workings from the actual solution.
That's actually a good, what you call it, yeah. So same thing with the lease liability. Same thing with the lease liability. The lease liability is increasing. The lease liability is a liability. A liability increases on the credit side. Okay, so that's what we're doing. The journal entry balances. There was no need to actually do both calculations. You could have just have it for one. The reason why I did for both, because remember, the right of use asset and the lease liability won't always be the same. In this case, the right of use asset and the lease liability is the same, because for the right of use asset, all the other four components is 0. So that is why it would be okay. But the moment any of these had to be a number, then the right of use asset and the lease liability won't equal each other. So just be aware of that. So here we go, format, do that. Working 1, and I want to show them working 3. Okay, so no need to still show it for both. Okay, so now we're going to do depreciation. Okay, so remember he didn't record anything. The only thing he recorded was this for the 19,000 or the 19 million. And we needed to add that 42 million. So we increase it by 22. So 22 and 19 gives you the 42 million rand. Okay, happy. Now we must do the rest. He never did anything else. So now we need to do the rest. So for the depreciation, we're going to say, what is depreciation now? Depreciation working 4. All we're going to do with depreciation, what do? We say costs divided by useful life, and then we get the depreciation amount. Okay. So for depreciation, it is costs, useful life, and that will give us an annual depreciation. Annual depreciation. Okay, so the cost is that 42 million. Is that 42 million. Useful life. So remember, how do you think through the useful life? With a useful life, there's one of two options. You must first run through option number one. If it's not option number one, then it has to be option number two. So option number one, I call it an options. Okay, it's not really an option, but basically option number one, if the asset is going to transfer to you, or you're going to exercise the purchase option, then you must use the useful life will be the useful life of the asset. Okay, so take note. If ownership of the asset is going to transfer to you, and or you're going to exercise a purchase option. So there's no purchase option, and they never said that ownership is going to transfer to us. So we can't use option one. But if it was option one, you will use the useful life of the asset. In this case, because we can't use option number one, we must use option number two. What is option number two? Option number two is, if option number one is not applicable, then you must use option number two. And option number two says the useful life will be the shorter of the lease term and the life of the asset. Okay, so the shorter is the lease term. Okay, so shorter is lease term. The lease term is 12 years. So therefore, this is going to be 42 divided by whatever this is, 12. So the answer here is, whatever this answer is, 3.5 million, and that is C49.
Faiz, can you please repeat option one?
Okay, I'm going to repeat it now. C49 equal that. I'll repeat it now. So option number one, remember it's not really an option. I'm just calling it options. So option number one is if ownership of the asset is going to transfer to the lessee at the end of the lease term, or the lessee is going to exercise a purchase option. If any of those two is applicable, you will use the useful life of the asset. If that is not applicable, then you use option two. Option two is you must use the shorter period of the lease term and the useful life. So in this case, the shorter period is the lease term, because the useful life is 23 years, the lease term is 12 years. So what is shorter? The lease term of 12 years. So we use that as our useful life for depreciation purposes. Okay. Now we're going to do the bank payment. Okay, so the bank payment, they said you must lump everything together. So we can lump everything together. So working 5, it is going to be monthly payment. Once again, you don't have to do this long thing. I'm just doing it so you can see, just to show you the thinking process that's going through my mind. In an exam, you can just write it out very quickly. With some of this working is too much in terms of the way I'm laying it out, for you're not going to finish in time. But I lay it out to show my thinking process. But when you do it, you just condense the thinking process to just try to write it in one line as far as possible. So monthly payment is equal to that 437.29. 437.29. Number of months. Number of months is 12, and that gives us whatever that gives us. So the bank payment, bank is going to be equal to that times 12. Okay, so this here is C53. So here we go, equal to C53, interest payment, C50, no, not interest payment, bank, C53, delete. I'm assuming, I think I was working 5. Okay, so there we go. Now I must work out the interest expense. Okay, so for the interest expense, so remember how we work out interest expense? We're simply going to say, what are we going to say? So remember what's the formula to work out interest expense is the following. Working 6. Remember interest expense, present value times I. So we're going to say present value I, and that's going to give us our interest expense. Now remember, we're working out interest expense for the year ended 30th June 2019. We're working out interest expense for the year ended 30th June 2019. So because it's for a, it's not going to be 100% correct actually. 100% correct. No, yes, fine. Not actually, but okay. So I'm just going to keep it simple, right? It's not 100% correct. I'll show you the 100% correct way. So present value, because we're working for the full year, we take the present value at the beginning of the year. So what is the present value at the beginning of the year? It is that 42 million. So what is the beginning of the year? So we're working out interest for the year 30th June, for the year ended 30th June 2019. So the beginning of the year is 1 July 2018, and the end of the year is 30th June 2019. So when we work out interest for the full year, 30th June 2019, we use the opening balance for that year, which is 1 July 2018. So the present value, the opening balance, or the present value of the lease liability on 1 July 2018 is that 42 million Rand. Okay, so I'm just going to say 42 million Rand. And I is going to be the 7.75%. So interest is going to be that. It's going to be slightly off. I'll tell you why now. Yeah, so it's going to be slightly off. I'm not going to go through the whole process now, but I'll explain why it's slightly off. Okay, interest expense. The mistake I'm doing over here is the following. The issue what I'm doing over here, I'm assuming there's one payment for the year. There's no one payment for the year. It is actually compounded monthly, so I'm going to be slightly off. The way to actually do it is to work out the present value at 30th June 2019. So when you compare present value 30th June 2019 to present value 30th June 1 July 2018, and you take into account the bank payment, you would actually end up getting the correct interest expense. I'll show you at the end. I first want to get this done because that is a minor calculation. So just to show you all the calculations, I want to do this quickly. So like I said, mine is slightly off because I didn't do monthly compounding. I just did a full year. So like for me in an exam, if I come to that in an exam, I know it is only going to penalize me half a mark. I trust myself the rest of the marks I'm getting. So I'm not going to go through a massive calculation to get a few percentage points difference. So I'll leave it like that. I'll just lose a half a mark. Okay, but I'll show you the correct calculation. So this year, you just get the balancing figure. The balancing figure is simply that minus that. So there, the thing balances. This is going to be working 6. The variable lease payment, it is, so like I said, they probably made a mistake here, okay, because they gave us the revenue for 2020. It should have been the revenue for 2019. If it is the revenue for 2020, then there's no journal entry, which does not make sense. So, because every year there is a journal entry, so they definitely made revenue, so there must be a variable lease payment. But the only revenue they gave us was June 2020, which is not which doesn't make sense. I'm assuming it should have been June 2020. It should have been June 2019. So that revenue figure was 4.5 million times 2%. Okay, so this here is equal to 4.5 million. 4.5, 1, 2, 3 times 2%. So it's 90,000. Okay, so there we basically go. Yeah, so that is about it for me. Then it's obviously deferred tax. So to work out deferred tax, we do the following. Working 7 for deferred tax, we're going to have asset liability. We're going to have asset liability. What's it? Asset liability. We're going to have carrying amount. We're going to have tax base. We're going to have temporary difference. And then we're going to have deferred tax. So we're looking from the lessee's perspective. With respect to this, the lessee has a right of use asset. The lessee has a lease liability. The lessee could have had a provision for dismantling. Okay, so I'm just going to put it in over here just for completeness purposes. They could have had a provision for dismantle. So, for example, if you have a look at the the right of use asset, there's a lease liability which we calculated. There wouldn't be an asset liability for that. There wouldn't be an asset liability for that, but there could be an asset liability for provision for dismantle. So that will draw deferred tax. For the lease liability, it will only be the lease liability, so that's fine. So there we have right of use asset. We have lease liability, but remember, included in the right of use asset could have been a provision. So there's a liability for the provision. So just take a note. SARS wouldn't have that provision. For our purposes, it's nothing. Tax base is nothing. Now, the right of use asset is equal to, cost minus depreciation, accumulated depreciation. It's only 1 year out, so we can just take depreciation. Where is that now? Depreciation. So that is cost. The lease liability would equal, so the lease liability would equal, so that's what the lease liability would equal. It would equal the lease liability, opening balance, minus the payment. The lease liability would be the lease liability minus the payment plus interest. Okay, so the lease liability would be opening balance minus the payment plus the lease liability. Okay, I mean plus the interest expense. So just be aware of that. Okay, so just take note of that. So obviously mine is slightly off because my interest expense is not 100% correct, okay? But we're not going to bother with that too much. So that's going to be, so for the tax base is what SARS have. SARS does not see a right of use asset, so it is 0. SARS don't see a lease liability, so it is 0. Remember in the scenario, they told you that SARS deduct 5% for factory buildings, whatever it is. We can't use that. Because from SARS's perspective, as the person who owns the building, who owns it? The lessor. So we can't get that tax deduction. So just be aware of that. So from SARS's perspective, We have a right of use asset, SAR sees nothing. We have a lease liability, SAR sees nothing. So the temporary difference, so obviously this is a lease liability. So you can decide what you want. I make my assets positive and my liabilities negative. So if I just say that carrying amount minus tax base, carrying amount minus tax base. So there we go. So it's temporary difference times 28%. Okay, so that would be, so there we have, so we have basically, if it's a negative number, in my case, it is going to be a deferred tax asset. So if it's a negative number, in my case, it's going to be a deferred tax asset. So all I'm going to do, I'm going to say debit, so it's a deferred tax asset. So assets is increasing, assets increase on the debit side. So I'm going to say debit deferred tax asset. And I'll have to credit something. So I'll credit with the same amount. I think this was working 7, I think so. So the other side of deferred tax, you circles it income taxes, okay? Which is correct actually. So P&L. So all of these amounts go through profit or loss. The lease liability, the interest expense go through profit or loss. The right of use asset, the depreciation goes through profit or loss. So therefore the full deferred tax income statement impact will go through profit or loss. Like I said, my number will be slightly off because that number is slightly off. Okay, but you will still get 100% for this. I'll show you later if you have some time the correct way of doing it. Okay, but that is basically the 18 marks for that is the 18 marks for part A. Now we need to do part B. But before we do part B, do any of you have questions on part A? Just quickly, yes, no?
I have.
Yeah.
Okay, you can go, Alison.
All right, I have 2 questions. For the depreciation, we have a residual value. Do we not take that into account?
It's not
when
our
we
residual
calculate?
value.
It's not, yeah, okay.
It's not our residual value.
Understand that.
So we're not going to get that money. The lessor is going to get that money. So we don't take it into account because it's not our residual value.
Okay, I understand. The second question I have is in terms of the calculation, you know, the calculation of the lease liability. I'm not getting that amount on my calculator.
Okay. What
So I'm not getting
calculation?
42 million. A shop, yeah, 738.
Sure. Okay, so what are you typing in? I don't know how the shop works, but
So
what are you typing in?
I basically typed in everything. So I'm not sure if it's my calculator or I'm doing something wrong.
So is your
Because
calculator, is your calculator beginning?
Yeah, it is.
Is
Calculate on
your
beginning.
so your calculator is beginning, and the periods per year, what is it?
So I set it on 1.
And if you transfer it to 12, make it 12 per year, because maybe that's the difference between the way Sharp works. I know Sharp's slightly different to HP. So if you change it to 12 per year, and then type it in and then see what happens.
All right, let me do that. And if I don't get that, then I'll just check with someone on the group. Thank you.
Alison, sorry, and Faiz, I'm experiencing the same thing as well, actually, and I'm also using a shop. I tried the changing the periods to 12, and I still don't get the 42. But as it was done on the spreadsheet, I was following through with the calculations, and it makes sense. But yeah, I just don't get the 42 on my calculator
Yes,
as well.
I will try to. I don't have a. I don't know.
Okay, I can help. I'm using a sharp. So the first thing you have to do before you punch the figures in there is to click second function, then click where it says FV, the future value. That way at the top of the screen, it should show a BGN.
Yes.
Then after it's showing the BGN, now you punch everything that was on the spreadsheet. It should give you a 42 million. I did it and it gave me that. I failed the first time, but then when I did the first putting the BGN on the screen.
Hi, sorry, can you tell me what was your future value? Was it a negative 2 million? Because maybe it's the signs that's a mess up, because I know that one of them has to be a negative.
Okay, so the way the signs work is as follows. The signs work as follows. Future value and PMT will always be in the same direction. So if you put future value negative, then PMT must be negative. If you choose PMT to be positive, future value must be positive. So future value and PMT must always be in the same direction. Present value and future value will be in the opposite direction. So that is basically how it works. So I always keep future value and PMT positive, and then automatically present value will be in the opposite direction.
Okay, let me just try this out. Thank you.
Okay, so I'm going to go on to part B so long.
Before you go,
yeah.
Faiz, I just wanted to ask on our deferred tax calculation, we have got right of use asset, we have got the lease liability, we've got the provision for dismantling. If we had prepayments and all of that, we would have to calculate the deferred tax on it.
There won't be a prepayment, because remember, prepayment is de-recognized at commencement, and prepayment will be de-recognized at commencement and included in so the journal entry for the prepayment is as follows: debit right of use asset, credit prepayment. So the prepayment is no longer there. With a provision for dismantling, the journal entry is as follows: debit right of use asset, credit provision for dismantle. So there is always going to be a provision for dismantling while we still have the right of use asset. And that is why we would include it. So the reason why I included the provision, so this will be the only things relating to right of use assets for deferred tax purposes.
From a leasee point of view.
Leasee point of view, yeah.
And from a lessor point of view?
That's a different story. For the lessor point of view, it depends how the lessor accounts for its lease, whether it's an operating lease or whether it's a finance lease. If the lessor has a finance lease, then they would have a gross investment in lease. SARS would have nothing, and they would have an unearned finance income. SARS would have nothing. But the important aspect over there, for the PPE asset, the lessor will have nothing because the lessor is deemed to have disposed of it. But SARS would have something, because SARS doesn't care whether you have deemed to have disposed of it. SARS still sees it that you own it, so therefore SARS is going to give you the deduction. So that is going to be the difference.
So for the lessor would have that gross investment in the lease, would have the unearned finance income, and what is the third one?
PPE, the asset, but
PPE.
zero under current assets, zero under carrying amount, and
Yeah.
an amount under tax base.
Okay. Or because now you have disposed of the asset, the carrying amount will be zero.
Yes.
But then you'll be So you'll be taxed on
So
or on the remaining tax base.
because SARS still has SARS is still giving you a deduction. From SARS's balance sheet perspective, you still have an asset. So when you look at it, when you look at the deferred tax this year, you must ask yourself, what does accounting have? What does accounting see? And then you must ask yourself, what does tax see? So when it comes to this over here, accounting sees that, tax sees that. For the lessor, accounting is going to see a gross investment in lease and an unearned finance income. What SARS sees an asset. SARS, you never dispose of any asset from SARS's perspective. So SARS would have an asset, an amount for the asset that you are leasing out. So that is basically how to be for a lessor point of view.
Up until you have got your full tax deductions, this is going to continue.
Yes.
Okay. Thank you.
Yeah, so Lynn, I'm assuming that would more or less be what you call it. So with accounting, I mean with Excel and with Excel and Google Sheets, their decimals runs forever and ever, right? So there's always going to be a rounding difference between what you get on a calculator and what you get on Excel. Always. Solutions will take that into account. So it could be that that is the case. So yeah.
Thank you, Faiz.
Okay. So let's go on to part.
Okay.
Any other questions? Yes.
Hi, Faiz.
Yes.
May you please shed some light on the paragraph where they are talking of the CPI? What did we do about
We're
that?
going to come to that now. Part B. Okay.
No, on this question where they're saying 4.5%, the lease agreement specifies that the lease payments will increase every year on the basis of the increase in consumer price index.
Deal with that now. Part B is going to deal with that now.
Okay.
I'm going to show you. I'm going to explain it now in part B. Okay, so let's do part B. So with part B, where's part B now? So part B says the following. What does part B say? Disclose the right of use asset disclose the right of use asset note to the financial statements of Catwalk Fashions Ltd for the year ended 30th June 2020. You may assume the following balances on 1 July 2019 as correct: right of use asset and lease liability. Okay. So let's have a look. Where am I now? So when we want to disclose something, we need to prepare the financial statements as it would look in the balance in the actual financial statements. Financial statements, when you prepare financial statements, there's always three things you must take down. It is the company name. So this here is Catwalk Fashions. Then it is the name of the statement, which is notes to the annual financial statements. Financial statements for the period. So because it's a year, we say for the year ended. Now, every financial statement is for the year ended. Only the balance sheet is as at. So remember, you need to get those wording right, because otherwise you will lose the mark for presentation, whatever communication. Then you put the date. The date you can just put next to for the year ended. I just always put it over here. But in the exam, you can put it next to for the year ended. Okay, so 30th June 2020. So now I know I got the company name. I have the statement name with the correct terminology as in for the year ended. And then I have the date. What's important to take note, if you're doing this for groups All you must do when it comes to groups is include the terminology consolidated. So if you're doing the balance sheet, you say consolidated SFP. For the notes, it will be in consolidated notes to the annual financial statements. That's the only difference for groups and non-groups. Okay. Now we're going to do the actual note. So the note we're doing here is the right of use asset. Okay, so that's a note that we are dealing with, and we would do it. So remember, let's see what they said over here quickly. What did they say? What did they say? So remember, they said, they say comparative figures are not required. If they did not tell you that comparative figures are not required, then we'd have to do 2019 as well. But because they said it's not required, we only do 2020. Remember, financial statements always includes comparatives. Comparatives is part of financial statements. So if they don't tell you to ignore comparative, then by default, a comparative must be included. Okay, so here we're going to do, it is 2020. So all a note basically does, generally a note is it's going to give a reconciliation of opening to closing. So it's going to be opening, and then it's going to be closing balance. So what the note do is provide a numerical explanation of how a balance went from the opening balance to its closing balance. That's all that the note is doing. Okay, so all the note is doing is explaining how the opening balance went from the opening balance to the closing balance. They gave us the opening balance, 38,500, 1, 2, 3. Okay, so they gave us. Now we need to ask ourselves, what can change this balance? Okay, so what can change the right of use asset? How could the right of use asset go from its opening balance to its closing balance? There's two types of changes, an increase and a decrease. So you ask yourself, what could increase a right of use asset and what could decrease a right of use asset? Okay, so that is basically what you think about. That's how you think through it. So what can increase a right of use asset? What can increase a right of use asset is any additions. Additions means that you enter into a new lease in the current year. In 2020, we did not enter into a new lease, so there's no need to include additions. I'm only including it here for you, so you can see for completeness purposes. The other typical way would be a reassessment. Okay, so a reassessment. So the right of use asset can change in a few ways. It can increase as a result of additions. It can change, meaning increase or decrease, as a result of a change in the liability number that we call a reassessment. So if a lease liability changes as a result of a reassessment, it also impacts the right of use asset. So we'll have here reassessment. What I think it's called a reassessment or remeasurement. Reassessment of, yeah, just call it like that. Reassessment of lease liability. Okay, so that's one. Another way the right of use asset could change is if there was a change in the provision for dismantle. Okay, so what could happen? We can just say change in provision for dismantle, or provision for restoration, or provision for decommissioning. We know there's no provision in this question. I'm only bringing it in just to show you that that could happen. Okay, And then the last one is depreciation. Okay, so the last one is depreciation. Now remember, for depreciation, because it's a straight line, we would basically use the same amount. But before you bring in depreciation, we first need to work out if there is any reassessment. In this scenario, there is a reassessment because of that CPI. Whenever you have a variable payment, and that variable payment that's linked to an index, and that variable payment that is linked to an index changes every year, then there will be a reassessment every single year. Okay, so in this case, we need to work out what is the reassessed amount. So remember, they said that there's a variable payment linked to CPI. The CPI changed in the 2020 financial year, at the beginning of the 2020 financial year. So the CPI changed at the beginning of the 2020 financial year, which means 1 July 2019. So that means we have to do a reassessment calculation. So what we're going to do is the following. To work out the reassessment, we're going to do the following. What am I doing? My brain just froze. Oh, okay. I'm doing that. Okay. So working one. So for working one, let's understand what we are doing. We need to do a reassessment. The reassessment is happening on 1 July 2019 because the CPI changed in the 2020 financial year, and they said it changed at the beginning of the year to that 4.5%. So all we're going to do, we will say, what is the current liability? So current lease liability. Okay, the current liability, they gave it to us, which was, I cannot remember, 30, they gave it to us 39,896,108. Just make sure I'm getting the right, I think taking the right number down. 39, what was it now? I just forgot. 39,896,108, right? 39,896,108. Just check that I took the right number down. And then we're going to say reassessed lease liability. We're going to have to work that out, and that will be the reassessment adjustment. The difference between the two will be a reassessment adjustment, either an increase or a decrease. Okay, so reassessment adjustment. Reassessment adjustment. So this was given. Just make sure that I took the right number down based on what the required gave.
The number is correct.
Okay. And now we're going to do the reassessment working two. So remember, the lease liability is just basically a present value calculation. So we're going to calculate present value at 1 June 2019. So we're going to need future value. We're going to need PMT. We're going to need N, and we're going to need I. So the future value did not change. We're still paying 30 million, and we're still guaranteeing 30 million, but the lessor is getting 28 million. So in effect, the guarantee is only to cover the shortfall of 2 million. So 30 million, 1, 2, 3, 1, 2, 3, minus 28, 1, 2, 3, 1, 2, 3. Okay. Okay, then what we're going to be doing, we need to work out what is PMT, what is N, and what is I. Now, remember, N is the number of periods multiplied by the number of years multiplied by the number of compounding periods per year. What's important, I should actually make that clear over here. So let me just go change it over here. Just to make it clear over here, it's the number of remaining. That's the important term. It's the number of remaining compounding periods. So we are 12 months have passed. So N is 144 minus 12, which gives us 132. I stays the same. There was no change in the interest rate. So it is equal to 7.75% divided by 12. In beginning. So it's going to be beginning. Okay, I'm going to say beginning. Okay, now here is where it comes into play. Remember, the fixed payment is 437. The fixed payment is 437. I think it was 609.29. Okay, just check that for me. 437, 609.29. But the payment is going to increase by CPI, the index of 4.5. So that's where we bring that in. So the payment, because of CPI, this is going to equal 437 multiplied by 1 plus the increase. The increase is the CPI. So instead of paying 437 in 2020, we're going to be paying 457,302. So now,
Sorry for ease.
yes.
Sorry, just for that payment amount, so it ends in 607, not
607.
609.
Okay.
Yes.
So I'm going to change it now. So it's going to be present value. That is, they want I, they want N, they want PMT, they want future value, then they want beginning or end. If it's end, we put in 0. If it's beginning, Google Sheets 1. So that's what I do. So there we go. That is the reassessed amount. Okay, so it's going to change slightly, but it must be 607. Okay. So the reassessed amount is 41. As you can see, it's an increase. So the journal entry for this, the separate journal entry for this would be as follows. The lease liability is increasing. So when you say lease liability, it's increasing. So therefore, we're going to credit the lease liability because it's increasing. A liability increases on the credit side, and we're going to say right of use asset. So the reassessment impacts the lease. The reassessment relates to the lease liability. But the standard says whatever impact the other side of the reassessment to the lease liability goes to the right of use asset. So that is why I'm taking it to the right of use asset. So the amount is going to be, this is what the reassessment is versus the previous amount. So it's an increase of 1.7. So the lease liability must increase. The lease liability is a liability. A liability increases on the credit side. That is what we're doing with the lease liability. If you read IFRS 16, it was going to tell you that the other side of this journal entry must go to the right of use asset. So because it is a credit to lease liability, we're looking for a debit. So therefore, we're going to debit right of use asset. A debit to a right of use asset is a debit to an asset. A debit to an asset means an asset is increasing. So when we come over here, we're going to bring in the right of use asset at that 1.5, increase the right of use asset by 1.5. And that is going to be from working 1 and working 2 will go over here. Now we must do depreciation. So remember what they're testing over here with depreciation, indirectly without you even knowing, is a change in estimate. The carrying amount of the right of use asset changed. So as a result, we're going to have to rework out depreciation. So what we will do when there's a change in estimate, we want to work out depreciation on an asset that, as a result of a change in estimate, we don't use cost price, we use carrying amount. We don't use useful life, we use remaining useful life. So this will give us our depreciation. Okay, so all we're going to do, we are going to work out what is depreciation. So depreciation will be whatever the carrying amount of the right of use asset is, whatever the carrying amount of the right of use asset is before depreciation. So as you can see, the carrying amount of the right of use asset before depreciation is going to be that 4256. So all I'm going to do, my carrying amount is equal to opening balance plus the change. The useful life we have used is 12 years, but we don't want useful life, we want the remaining useful life. So we say useful life minus whatever has passed. 1 year has passed, so therefore only 2019 has passed, so therefore the remaining useful life is 11. So we're going to say carrying amount divided by 11 will give me that, whatever that amount is, as our depreciation. What does depreciation do to the right of use asset? It reduces the right of use asset. So this is going to equal negative C29. So my closing balance of the right of use asset at 30th June 2020 is 36,597. Okay, so that's the 7 marks for that's the 7 marks for whatever this is. That's the 7 marks for what you call it. So do you have any questions at this point in time? I'm going to stop there for tonight. We don't have any questions. For those that is registered for the test 4, just WhatsApp me your number. I don't have your numbers, but I didn't ask for the numbers when you registered for the course. So WhatsApp me your number to my WhatsApp number, my business WhatsApp number.
Which is?
And then tell me your name so I know who it is. Because what I'm going to do, I'm just gonna do a video recording, or I'm gonna do a voice note on WhatsApp for part C, and then I'll just send it to you guys. I'll just create a group and I'll send it to you guys for test 4. I'll shut down test 4 group after test 4 is over. Let me just see what I want to do here quickly.
Faiz,
Yeah.
I still don't understand why the calculations that we do now on the note were not part of the journal entries.
Because the journal entries was for 2019, this is for 2020.
Oh, okay.
That's an important
Alright.
aspect to know which year period you're working with. Typical, eh? So, so just be aware of that. So that's a good thing you identified now. So now, before you start any question, you must tell yourself, be aware of the accounting period that I'm dealing with. So you can see, like, you didn't pick that up now, but now you realize you don't see a correlation between the journal entries and this. Why? So it's because of which period we're busy with. So now whenever you start an accounting question, That's one of, so you can see you would have made that mistake most likely. So you picked it up now. So before you do a question, tell yourself that you must look out, or you must be on alert for which accounting period you're busy with. Very important. So that's my my business WhatsApp number. That's the Edion's WhatsApp number. For part C, it'll be like a few minute voice note. I'll do it. I'm not going to do it now. But just send it. I'm going to create a test 4 WhatsApp group. So I'm going to send it to my students in the registered, my registered students. I'll just send the same thing to you guys as well. But note, I'm going to delete the test 4 the test 4 group after test 4. Okay. Because I don't create a test group because I'm gonna have to delete it all the time. So, but because I want to send this, I don't want to send individuals. So just send it. I'll create a group tomorrow, later or tomorrow, and then we can. I'll send out the voice note. So before we end, is there any questions from your guys' side on part A and part B?
I don't have a question relating to this, but I have a general question. Faiz, what is your pass rate for your students for test 1 and 2 so far? Because 3 results are not yet out.
Hey, it was asked them, eh? So some of them, some did well, some passed, some didn't pass. The question is, what do you consider to be a pass? Is a pass 40%, 50%? That's the question you need to ask yourself. What is the pass rate? What do you consider a pass? In my view, a real pass is 50%, but a CTA pass is 40%. So whoever makes 40% for CTA effectively passed, why? You're going to qualify for the exam. A real pass is obviously 50%. But if you can get 40% in a test, you'll be able to pass in the in an exam. So whoever shared with me, obviously the people that share with me is most likely people that did well. So most of the people shared with me the results did well. There are some people that didn't do so well, but they have improved from test 1 to test 2. Test 3 must still come out. We'll see how test 3 goes. The common issue from those that didn't do so well in test 1 and test 2 is not on content. They feel they know their content, but it is time management. So that is something you kind of have to learn about. If you are close to 40%, then don't stress. Yeah, the idea here is to make exam entry. So if you close on 40%, don't stress. You will be able to make the exam. The stress lies in if you're below 40%. So anything below 35% is running high risk because the chance of you being pushed over into the exam is slim. But if you're making 40%, don't stress too much about it. So yeah, I don't know if that answers your question. I don't know all the, not everyone, they're not obliged to share results with me.
Okay, then another question that I have, your full-time students, how often do you have such live classes with them?
Every week.
Every week?
Yeah.
And then do you have sort of tutorials that you give them over and above the UNISA ones, or a test that you set up for them prior to the actual UNISA test?
I only use UNISA. I think the only time I will set up my own questions is when UNISA knocks on my door to say I can't use the questions. While UNISA don't bother with that, well, technically I should be setting my own questions. I don't think I can actually use UNISA questions, but I can argue it's helping the students do better. So at this point, I only use past papers. I don't use anything from the activities in the TAT letters. For me, I won't say it's a waste. It's good for someone learning, but not for me teaching what you call it to basic. So I only use past test papers and past question papers, and depending on the level, I'll sometimes use a psycho paper. Sometimes it's good to work through psycho papers, but because psycho paper is obviously too integrated, you can't always use it. But like if I find one question that is pure a topic, then I will use a psycho paper because it gives you a feel of what you can expect. Otherwise, I just do test, and in the exam, I will do the TAT letters, the exam pass papers from the TAT letters. Yeah.
Okay. Thank you.
Okay.
I think I'm
Faiz.
sold.
Yeah, we must be.
Faiz, I have a question.
I just have a quick question.
Okay.
Oh,
Sorry.
Yes.
You can go.
okay. I wanted to ask Faiz about. So you just shed some light on the lease reassessment, right? That's a situation where the terms that were initially agreed upon change during the term of the contract, right? So then you would obviously affect the differences in the calculation on the lease liability and the right of use asset. Now, in terms of a lease modification, you once said in earlier session that you would create a separate, it was be recognized basically as a separate lease. You said something like that, you know.
Yeah.
So I just wanted to have a picture of, from a practical aspect, firstly, how do you identify that this is now going to have to be a lease modification, as well as the practical aspect of how you would deal with it from maybe like a journal's perspective.
So for a lease modification, if the scope of the lease increases, so for example, over here we leased a factory, right? If there's a change in the contract to say that we can lease 2 factories, so that is an increase in the scope of the contract. That will be a lease modification, and a lease modification is accounted for as a separate lease. In this scenario, there's no increase in the scope. It is just basically a change in the lease term or a change in a number, like payments or something of that nature. So that would be a reassessment. But the moment the scope of the lease increases, so which assets we can use and all of those type of stuff, then that's considered a lease modification. And like we said, a lease modification, you account for it as a new lease. So you'll go again, initial recognition, subsequent measurement, like you do a normal lease.
Oh, that makes sense. Thanks.
Okay. Lynn?
Okay. I just wanted to know about the FAC4 class, yes. Will it be tomorrow and Sunday, or is it next
Oh,
week? And what time will it be?
yeah, thank you for reminding me. I mean to actually mention it. Yeah, so the FAC class is going to be tomorrow, both sessions. So we're going to run 8:30 to 10:30, give you an hour break. Then we're going to run from now we need a 1.5 hour break. Then we're going to go from 12 till 2. So I'm going to send out the things after this class now. I'm going to send out the meeting requests with the links now.
Okay, thank you.
Any other questions?
Faiz, you said 8:30 to 10:30, then 30 minutes break, then we start 11.
90 minutes break, and then 12 till 2.
Or 12 until 2.
Yeah.
Okay, thank you.
Any other questions? No questions? Okay, so guys are good to go. For the test, look at people that's our test for, just send me your number. If I have some people's numbers already, but just for those that don't have the number, please send me your number, and then I'll add you to the group. Okay, bye-bye.
Bye.
Thank you.
Bye, Faiz. Thank you.